A very good evening to you all, friends. I am Sanjeev Singhal, Chairman, Auditing and Assurance Standard Board. On my behalf and on behalf of my Vice Chairman, Vishal Bhai Doshi ji, I welcome you all to this 116th program of AASB for this council year. And today we are going to discuss about materiality and its role in planning an audit and in issuance of the final audit report. We have with us the esteemed Chairman of the Rohtak branch, Gaurav ji, and very esteemed speaker, Pratish ji. I would request the chairman of the Rohtak branch to give welcome address and then invite our esteemed speaker Pratish ji for his deliberation. Thank you.
Thank you so much, Sanjeev sir, for giving this wonderful opportunity to moderate this webinar on the topic Materiality Essay 320. First of all, I would like to welcome our guest speaker Pritesh Amin sir. And before starting the session, I would like to read out the brief profile of Pritesh sir. Pritesh is into the capital market, equity investing, and his prior career had been in external independent audit and public accounting. Pritesh was a partner in audit and assurance service line with the Baroda-based chartered accountant firm, prior to which he led Deloitte Baroda office external audit practice and had been with Deloitte for over 15 years. He has experience in audit under IFRS, US GAAP, due diligence review for takeover propositions, for strategic alliance and for spin-off units, advisory service in connection with IPO management and internal audit, statutory audit under the Indian Companies Act, and advisory services in connection with shares valuation business setup. He has been on a short-term work-related stint in Australia, United States, and United Kingdom. He is a Bachelor of Commerce, the Maharaja Sayaji Rao University of Baroda. He is a fellow member of Institute of Chartered Accountant of India, qualified in 1998. Thank you, sir, and I would like to welcome you to this session, and over to you, Pritesh sir, and welcome you.
Thank you for the introduction and thank you for inviting me to this program. I thank the chairman of the ASB board, Mr. Singhal. I also thank the in absentia Vice Chairman, Mr. Vishal Doshi, and Mr. Gaurav Bansal out here, and Mr. Anil Lal for coordinating all of this. So, since we are aware of the topic, I will get straight into it. I have roughly planned for around 90 minutes or so of my topic. And so let me get into it. If there are any questions, you can put it in the chat, or as the case may be, it may be asked at the later part of the session. I am more than happy to be available even subsequent to the session if anyone has any questions. I'll leave my contact details and everything with the ASB secretary, and they can share it with all the participants as the case may be. Right. So let me get to the topic. Let me share my screen in the first instance. Let me start off with the topic with questions, basically, because this is a topic which anyone who is into audit is actually aware of. They would have gone through this. What is materiality? What is evaluation of misstatements? When materiality is to be used? Why it is done? What is the purpose? Know how to calculate, how to determine, right, and how to use it for evaluation of misstatements. So all of these things are actually known to great extent. Now, let me try and put it up in terms of questions. Now, this is something, let me upfront tell you this, that I don't have a PPT out here. What I'm going to be discussing with you is a topic from all the documents available publicly, made available by ICI on its own website, right? It's freely available for everyone, for all the members particularly as such, and wonderfully done to great extent. If you read through the material, you'll get a good idea of the entire topic. You got a good amount of implementation guide. You also got tools to use for that purpose. So like I said, I have not made a PPT for it for the simple reason there's a good amount of material already available, which is very well done and which explains very nicely the entire topic, which also explains in terms of how to implement it. So bear with me to that front. I'll take you through those questionnaires, through the implementation guide, through the PPTs, through the Excel template with the institute has come out. The Center for Audit Quality Director has come out recently. Okay. So let me run with that. let's start off with the questions. First, the MCQs. I would need it to be interactive. I would need you to respond to the questions, right? In planning the auditor makes judgment about the size of misstatements that will be considered material, true or false. Please respond to this question. We can make it more interactive. As the case may be, then we are able to, discuss it accordingly. Why I'm taking the MCQs first is basically if the MCQs give me an idea, give us a barometer of where we are, then the amount of discussion will be limited and restricted accordingly. Right? Could you please respond, participants? I would advise you to respond to in the chat box where I can see it. Gauravji, Alinji,
Yes, sir.
are there any responses coming in? Because I am unable to see it.
So can you hear me? Sir, the responses will be come from another side. Then I'll forward. If any response will be there, then I'll forward it to on the at the WhatsApp only.
Oh, okay, okay. So this will not be. I'll not be able to take feedback currently out here.
No, sir.
Okay, okay. Fair enough. Then let me make a change to this. I was trying to structure it through the MCQs, but let me get back into then this topic directly like this. Let me get to the implementation guide. This implementation guide is made available by ICI on its website through the resources section. You can go through it. It is available from free resources available. You can download it from there. There are a good amount of implementation guides available for different standards as such. There's also one on 320 and 450. 320 being materiality in planning and performing an audit, and SA 450 being evaluation of misstatements. Okay, so let me take you through the first page in the first instance. MCQs and the ones, I'll give you links of that in the PPT which I'll share with the ASB secretary, and they'll be able to put it up on the website as such. Like I said even earlier, all of this is publicly available. Nothing which I have made, nothing which I need to make, nor does anyone need to make that. This is implementation guide to materiality planning and performing an audit. It was, issued way back in 2012 itself. The standards 320 and 450 are applicable from 1st April 2010. This was issued in 2012 itself. This gives a good summary of the standards, concise form, exact, as well as the implementation guide in terms of examples also. How you can determine the planning materiality, the performance materiality, the evaluation, accumulation, and the entire thing. Okay, let me get back to this. Like I mentioned earlier, the standards are applicable from April 1, 2010. Overview of SA 320 will give you the scope, materiality, effective date, objective definition, requirements. We'll go through by simply scope. What 320 deals with is auditor's responsibility in applying the concept of materiality in planning and performance. SA 450 deals with application of materiality in evaluating the effect of identified misstatements and uncorrected misstatements. Again, there's one another standard 540 or 530 rather, audit sampling, which also brings in indirect reference of materiality. It does not have a direct reference, but in terms of tolerable misstatement. So there is an implementation guide available for 530 also. But given we are looking at 320 and 450, I restrict myself to those standards only currently. But you will need to refer to that also when you're looking at application of materiality, right? Application of materiality and use of materiality in evaluation of your sampling conclusions. Then finally, the results for your reporting purposes, okay, which is covered in SA 450. So again, to reiterate, the scope of SA 320 is planning and performing an audit. SA 450 is evaluating the effect of identified misstatements and uncorrected misstatements on the audit and the financial statements, respectively. What is materiality in the context of an audit? Again, there's a financial reporting framework. If that specifies, you need to fall back upon that. You need to use that also to determine the materiality in the context of preparation and presentation of financial statements. Where an FRF does not do so, then you've got the auditing standard to fall back upon. Okay, but in our case, in the Indian context, there's a good amount of materiality references given across standards as well as the Companies Act, that under which most financial statements are made, or even for other acts wherever it is applicable. Okay, so materiality in the context of an audit, FRF is financial reporting framework. Normally discuss materiality in the context of preparation and presentation of FS. What is a misstatement? Misstatement is material if in aggregate or individually is likely to or may influence the economic decisions of users. Now it is simply put, right? If there's some error or some misstatement which could influence the economic decisions, it is material. Simple as that. Then there are judgments which are made on materiality made in light of surrounding circumstances. The nature, the size, the circumstances in which they occurred, all of that need to be considered and factored in. Okay. Then judgment on matters, material for financial statements are based on common information needs. Obviously, we can't design or tailor for each and every stakeholder group as such. We are auditing and expressing an opinion on general purpose financial statements. When I'm talking about it, I'm only talking about general purpose financial statements. I'm not talking about special purpose financial statements. And when we talk about general purpose financial statements, as we are all aware, there are many user groups. So this is supposed to meet the common needs, financial info needs of the group as such, and not a particular group or an individual group as such. So the lenders may have a different consideration, the stakeholders may have, the shareholders may have a different consideration, the employees may have a different consideration, management may have a different consideration, but we are broadly looking into common needs of all the user groups as such. Again, determination of materiality is a professional judgment. Mind you, professional judgment. So you have to carefully exercise your judgment as such. You have to be diligent in exercising your judgment. You have to base it on reasonable basis, right? You have to document it. It's a professional judgment. And in the current day and time, as we have seen NFRA, giving out observations and reports almost on a monthly basis. You got 3 to 4 reports coming in or 3 to 4 orders coming in, where it has reviewed the financial statements of different companies. Obviously, those companies which have already fallen into hard times and which have already been found to be serious lapses, governance issues or whatever, and those have been picked up and those have been already reviewed for audit work. Simultaneously, I'm sure over a period, they are going to be reviewing other financials where those entities may not necessarily have been identified with serious lapses or governance issues, but nevertheless, they will do it on random basis as the case may be. This is what I expect it to go forward. But currently, as it stands, they've already gone into those entities where there have been serious lapses which have been noticed, observed, or caught in the sense, right? So it's a matter of professional judgment, and your professional judgment needs to be properly documented. To great extent, NFRA observations are common, which says that there was no assessment of materiality. I'm not talking about each and every individual case. I'm talking about broadly the observations which have come out of NFRA, which is basically to say that materiality assessment was an afterthought, was done later in some of the cases, some of the instances. Where it was done, it was not used anywhere. It was an orphan document sort of a thing, right? It was not used for planning and performing an audit, nor was it ever used in sampling, nor was it ever used in evaluating the misstatements, nor was it ever communicated to the governance, right? Those charged with governance, which is to say the board or the audit committee as such. So there were serious lapses the NFRA observed, and I'm sure, given we want to be in this field and we want to execute it properly, we would like to document it also properly, even where we have done it. Where we have not done it, we need to pull up our shoes and actually get into it in that sense. Auditors have to assume that the users, because we are doing for common information needs, that all the users have reasonable knowledge of business and economic activities. They are willing to study the financial statements. They understand the financial statements, how it's prepared, presented, and they audit it to levels of materiality. They recognize the inherent limitation and then make reasonable decisions. Because this is something which you have to start off with even otherwise. For preparation, presentation of financial statements, many things are common. For determining materiality also, this is common. Consideration of materiality, again, planning and performing an audit and forming audit opinion. The forming audit opinion comes, it is covered by SA 450, planning and performing audit, SA 320. What do? You determine the nature, timing, and extent of the risk assessment procedure, where the blue board or blue boxes are determine nature, timing, and extent of risk assessment procedures. Okay. Then you identify and assess the risk of material mistake. So for performing all of this, which is typically in the 300 section of our auditing standards, engagement quality control standards, right? Particularly essays 300s will cover essay 300, 315, 320, 330. Okay. So, but you need to find out or determine a materiality. And that materiality will be used for identifying or determining the nature, timing, extent of RAB, assess the risk of material misstatement, and then determine the nature, timing, extent of further audit procedure. Auditor's objective, obviously apply the concept of materiality in planning and performing an audit as far as SA 320 is concerned. Definition of what materiality is, what performance materiality is. There's a difference between materiality and performance materiality. So let us look at performance materiality. It is an amount set by the auditor at less than materiality of FS as a whole to reduce to an appropriate row level. Probability that aggregate of uncorrected and undetected misstatement exceeds materiality for FS as a whole. Let me try and give you an example for it. Let's say I'm taking an example from an engineering background to make it more relevant. Then we try and link it up with the financial statements also. Let's say someone has given you an order to make an elevator carrying 1000 kgs. Okay. So if you're an engineer, what would you do? Would you specifically make it for only 1000 kgs? Or would you try and do it for furthermore? Okay. Typically, we know how people actually get into an elevator. They don't really look at the boards. They don't even look. They are not even concerned, and they just get into it. So you can't do it at 1000 kgs. You'll typically try and do it, with sand capacity or bare capacity of probably 1250 kgs, 1300 kgs, or even 1500 kgs for that. But when you specify that this is, 95% confidence level that 1000 kgs it will definitely pick up, if not more. Okay, you may have made it to a certain extent that possibly it could even carry 1300 kgs or 1250 kgs for that matter. Okay, but that is what materiality and performance materiality is analogous to, right? You have a materiality for the financial statements as such. Let's say you got Reliance, which has profits of more than 30,000 crores pre-tax. Okay, I'm just taking up the numbers. I'm not talking about the numbers which is there currently, but 30,000 crores pre-tax. So what will be the materiality? Since it's a listed company, since you don't expect many major changes to happen, or you noticed on no major change in the current year, though a Reliance Group, you'll have definitely some major change going forward every now and then. But let us take for the sake of our argument and for our illustration that there's no major change. Then 30,000 crores is what you would expect it to grow by 5%, 10% more every year, roughly, let's say. So you take up a planning materiality based on the previous year number to be conservative, let's say at 5%. Okay. I'm just taking examples. Don't quote me on the benchmark. Don't take me in terms of the appropriate percentages for the benchmark. We'll look at that going forward. Okay. So you take 30,000 crores and you take 5% of that, which is 1,500 crores. Okay. So you are happy or you're okay with if there's a misstatement to the extent of 1,500 crores, you would still go ahead and sign off on the financial statement showing true and fair view if the financial misstatements are below 1,500 crores. That is what materiality is all about. But when you do the work, right, you try and say not 1,500 crores. Because what happens if you come close to 1,400 crores or 1,300 crores, the misstatements, and that is not based on the entire population check. It's only based on sampling. So you obviously get jittery if you're going to get close to that, right? So what will you typically do is, you come down to 1,000 performance materiality. For the financial statement as a whole, you could also break it up or take it to the level of account balances, class of transactions, disclosures, presentation, either case may be. More presentation is a later part of it, but at least account balances, class of transaction, and disclosure as a case may. So you would want to break it down to that level. Okay. Now you may want to do it at the overall financial statement or at the assertion level. Okay. So performance materiality is also something which you can set up at the assertion level, in addition to being at a financial statement level, at the assertion level. Assertion level, again, we know what the assertion level is. And typically, let's say property, plant and equipment. What are the assertions which you make out? When you put a number to PPE on the balance sheet, you're making that there's an existence of this assets. That's an implicit assertion. You don't need to make an explicit assertion for it. Then it is owned by the company, right? There are no other obligations, encumbrances. If there are, they'll be mentioned, they'll be disclosed, right? It's properly presented, the valuation is proper, okay? The recording is proper, the completeness. So these are assertions, okay? So when you do it and take it to that level as such. So you may need to set up performance materiality at that assertion level if you think, or if in your judgment it is fit or right to do so. That will obviously be based on the individual circumstances and the individual client. Again, this topic, as broad as it is and as important as it is, but be mindful that there's no one size fits all, right? I'll probably be repeating that sentence even going forward, but there's no one size fits all. Be mindful of it. So individual case to case, company to company, you will have to determine the materiality based on the circumstances, based on the understanding of the entity, based on the situation, right? Based on the regulatory requirements, based on the stakeholder group requirement, whatever. There are many things. Okay. So performance materiality, again, I am just trying to give an analogous example. Like I mentioned, you make an elevator to withstand probably 1,300 kgs, but when you actually fit an elevator into the building, you don't say it can take up to 1,300 kg maximum. You say it is only for 1,000 kgs. Okay. As a producer, I would say that to the building administrators or the builders as such. The builders may still want to water it down. They also are not sure. If they say 1,000 kgs, it might go beyond 1,000 kgs. So they will also say probably it can withstand only 800 kgs. Okay. So that is how you bring it down again going forward. Okay. So performance materiality, and this is applied right across for the financial statements as such. Determining materiality and performance materiality in planning. First, like I mentioned, overall final materiality for the financial statement as a whole. Obviously, it's required. I gave an example of Reliance Industries. Let's say Reliance Industries 30,000 crores pre-tax profit, 5% I take up. It's 1,500 crores. So that is at the financial statement level. And that level of materiality is across all financial statements, not specific to just balance sheet, not specific to just the cash flow or the P&L or the SOC, statement of changes in equity, right? It is across all the financial statements. It may have been based out of a benchmark which is flowing from a profit and loss statement or an income statement as such, but that materiality will be applicable across the balance sheet and the cash flow and the SOC also, right? So overall materiality for the financial statement as a whole. Again, you want to bring it up to a level where you're comfortable signing off on the financial statement saying as a true and fair view, even if there were misstatements to that extent. Right? That is what it is. Then, like I mentioned, materiality for class of transactions, account balance, and disclosure. You may need, now again, there are regulatory requirements. There are requirements which you may think that you want to bring it down to a lower level. So it could be at class of transaction level, account balance, or disclosure as the case may be. Let me give you an example. Related party transactions play an important role, and related party transaction is something which is, regulatory requirements may gives it the sensitivity. Okay, it is required to be so reflected and presented in the financial statements reported to the SEBI also, the stock exchange, SEBI through the stock exchange basically, and that is to be publicly available. So we know why and what is the importance, but the level of importance which it is given to related party transactions, to managerial remuneration, to sitting fees to directors, or many other things of that sort. Where the law or the regulation requires specific focus, specific disclosures. In such a case, you cannot live with a high materiality. You cannot say 1,500 crores is the materiality and I am okay with any transaction. If it's less than 15 crores, I will not even bother. Fine. You can't do that. If it's a specific form of disclosure which is required to be made, account balance, because of a regulation, because of an authority, or because you judge it fit to be, you can bring out the materiality out there. you can lower the materiality. You cannot have a higher materiality from the financial statement level. Let me clarify once again. You can have a lower materiality but not a higher one. Okay. So after you do that, you assess the risk of material misstatement. Again, when you pick up the financial statements, you look at the financial statements, you look at the balance sheet, you look at the PP, you look at the investments, you look at the other asset balances, non-current assets, current assets, right? You look at the uh, liability side, you look at the equity side, and you find out what is material in there, what and how you want to address that. Okay, what are the audit procedures that you perform? If it is, such a small, minuscule balance, which is probably even less than the clearly trivial, are you going to do the full extent of the procedures? Are you going to be having focused procedures? Are you going to not perform any procedures? Are you going to perform limited procedures? These are questions which will be answered. Once you determine materiality, you will decide or assess the risk of material misstatement in every balance. See, company to company, this will differ. Some companies will have a high PP balance as compared to current asset balances. Okay. Some companies will have reasonable PP balances as against a higher current asset balance, which is inventories, receivables, and cash equivalents. Okay. So in such a case, you will focus more out there in that case. Many companies don't have a significant non-current asset balance, but some companies do have a huge investment balance also, right? So you might need to focus on that again. So risk of material misstatement, what could be materially misstated and what could impact the financial statements, right? The economic decision of the financial statement users could be determined based on that. Now coming to benchmarks, I'm running through this because I would like to spend my time on the Excel template as the tool which is available. That is, pretty much self-explanatory to great extent. And once you start working on that and looking at it, I'm sure many of the queries would be resolved if there are queries as such, or it will come naturally. Though obviously it's a tool which is made available to you, and that tool can always be better, right? New things can come up. So use it as a tool, as a starting point as such, and use your judgment of how to better it or how else you need to bring in something else, right? Using benchmarks. Now, what are the benchmarks you typically use? Now, it depends on the type of entity. You need to understand the entity in the business. You need to understand the regulatory requirements, right? You need to understand the user's requirement as such, and then determine what is it that they will focus on primarily. Okay. There's a possibility that you may come to a conclusion. It's not just the profit, it is also net assets, which is of interest to the user group. Okay. They're focusing on that also. They're also focusing on revenue. It could be so, right? If it's a startup entity, typically they may be bothered about cash flow, cash burn rate more than anything else, right? So depending on the entity, the nature of entity, the time or the mode of incorporation, uh, the experience, the history, all that factors in, right? Okay. So involves use of professional judgment. That means starting point, you apply a percentage to a chosen benchmark. Now, this percentage is not set or cast in stone. Nowhere in the world or globally is it cast in stone. It just gives you benchmarks. It gives you, through examples, it tries to explain what could be used, what could be appropriate, right? So someone could have a 5% on profit before tax, someone could have 10%. And in example, then in this document itself, we have gone up to 15% also, right? So this document implementation guide has examples below this presentation. There are quite a few examples which they've tried to take up in terms of how to determine materiality, which are good enough. So you started from 5% range to 15% of profit before tax. So, okay, now no two persons' opinion will be exactly identical always. Okay, so you will have a view, but you should be able to base your view on a rationale. Okay, it should be well thought out, reasoned view, and that reasoning should be obviously documented. Okay, that is what it is. I might take up 5%, someone else might take up for the same 7.5%. Someone in Reliance, looking at Reliance, they may be comfortable with 7.5%. I may be with 5%. Someone will say no, 5%, 3% of PBT. Possible. Okay, so possible, but is it well reasoned or not? Again, higher materiality versus lower materiality. See, if you got a lower materiality, you end up doing more work. Okay. If you have a higher materiality, you end up doing lower work. Typically, that's how it's supposed to work, because that is related or to audit risk, which is again a function of your risk of misstatement and detection risk. Okay, so sampling and everything. So there's an inverse relation. The lower the materiality, higher the work, higher the samples. Higher the materiality, lower the. Okay, so once you determine materiality, you need to be careful. So if you got a materiality which is a lower one, you may end up doing higher work. But the chances of your being ineffective may be lower, may be lower. I'm not saying that it completely eliminates or cut downs on your chances of being ineffective. Okay. Whereas if you take up a higher materiality and do lower work, you may do lower work and you may turn out to be efficient, but that may be at the cost of being effective. You may end up having wrong conclusions on the population, right? So that is something which you always need to factor that in. Okay. So anyway, so the chosen benchmarks, you start from base of prior period financial results, state of affairs, period to date results, right? Budgets and forecast. You're obviously working on determining materiality for the year of audit, not for the previous year. Previous year is only a base for you to work with, right? Let's say if I start off a audit for March 24 in year ending, currently in October or November, then I can have annuals or forecast or budgets, how good those budgets and forecasts were earlier historically. That is what I need to factor in. I may take the previous year also as a base. I may take results up to September, October, as a case may, whatever is available to me. Then base my determine my materiality accordingly, right? So you need to factor in all of that. So I can't say that 30,000 crores was the previous year and current year the profitability. So far, it's already shown that there are events which will not lead me to profitability anywhere close to it. Probably will be two-thirds of the previous year. Then I will have to factor that two-thirds of the current year, because I am determining a materiality for the current year, not for the previous year. Previous year is only a base. So when you can use that, okay, if it is consistent, if there's a history available, so there are many factors. And it's much in the realm of common sense. I don't need to belabor the point on that front. Materiality for classes of transaction, account balances, and disclosures. Again, factors that may indicate to set a materiality level is laws and regulation. LNR is laws and regulation, or the financial reporting framework. Okay, the financial reporting framework may give you this one. Like the financial reporting framework gives us that we need to report managerial remuneration to directors, we need to report sitting fees to directors, whatever be the quantum, it may be minuscule as such. We need to report related party transactions clearly. Then there are many other additional MSME disclosures and many other things, which if you were to look at it, if the law did not specify, if the FRF did not specify, you probably may not have gotten into that greater detail, considering the materiality level. But now that the law or the regulation or the FRF sets up this expectations or lays down what is required to be done, and that is a specific disclosure that you need to make, then you may need to factor that in. At that account balance level, class of transaction, or the disclosure level, you may need to bring down your materiality or performance materiality. Not the financial statements, but at least those levels. Key disclosure with respect to industry in which operates. People who worked in the pharma industry, you will typically see in the LR results which are come out, right? The quarterly results which come out, R&D expense. Okay, that's a key disclosure which comes up. Every industry is something or other, but typically oil and gas, there will be proved reserves and everything else. Okay, the 2P, 3P of the reserves that would be mentioned. So, because those are huge estimates that could uh, turn your financials topsy-turvy depending on the estimates, how the estimation has been done. Okay, so those are key disclosures also of those estimates. So, if those are disclosures which are given as a part of your financial reporting results, as the case may be, you need to factor that in. Okay, because those are things which the user groups are interested in looking at and focused on looking at it. Okay. So focus on particular aspects of entity business. Revision as the audit progresses. Obviously, this cannot be labeled all the more. Or planning itself is dynamic. It is to be, it never ends till the very end. Okay. You need to keep on what do you say? Keep on reviewing it, reassess, revise as the case may be, if required to be, right? Similarly, it is applicable for materiality. And once a materiality is required to be revised, then you'll have to relook in terms of the nature, timing, and extent of the audit process that you perform. If any further needs to be performed, right? Again, it could have questions later on evaluation of misstatements also. Now, documentation, again, I don't need to belabor the point. NFR observations, people who have been looking and reading those orders would also be very clear that documentation is very, very, very important. Even where people have done it, it does not come out in the documentation so clearly. So here the standard very well lays down what needs to be documented. Obviously, the materiality for financial statement as a whole, materiality level for class of transaction, account balance, disclosures, performance materiality if it is set for class of transaction, account balance disclosure, that too, any revision to any of the above. Okay, all of this needs to be documented. Your nature, timing, and extent of audit procedures, risk of material misstatement, that is covered by other standards and not here by 320 specifically. So that is why we are not talking about that documentation out here. But that obviously needs to be documented clearly. What were the risks that you identified? Many observations from NFRA came out that there were no, material misstatements identified, no assessment process done. So that also we know, we have read from the orders as such. Now coming to 450. Okay, SA 450 is evaluation of misstatements identified during the audit. Like I mentioned earlier, there was that diagram as you saw earlier, that materiality is planning and performing, evaluation of misstatements. Again, there is 530 to a certain extent, not an exact what do you say, exact match in terms of materiality expectation out there, but the concept of tolerable misstatements and everything flows to a certain extent from this understanding of materiality. So that is why I say 530 is also needs to be referred to, which you can refer to. There's an implementation guide available for that also. There are tools also available for determining that. Okay, so SA 450 comes down to evaluating misstatements identified during the audit. Now, 450 is the conclusion of your sampling process, typically. Okay. After this step in this stage, you go off to concluding and reporting, which is to say the audit opinion, the SA 700 series. Okay. But SA 450, first and foremost, look at it. Scope, identified misstatements, the effect on the audit, uncorrected misstatements, if any, on the financial statements. Like I said, there are identified misstatements and there could be undetected, unidentified misstatements. As a part of the audit process, you typically try and see there it is free from material misstatements. Okay, but you can't conclusively answer that it is completely free from material misstatements unless you obviously check the entire population. Then too, you cannot have a conclusive assurance on that front. Okay, but nevertheless, so when you got identified misstatements, then you need to look at the nature, the size, the circumstances of its occurrence, how and when did it occur, does it give you an idea of any fraud, right? Or is it just a pure error? Is it anomalous? Is it isolated? All these things will matter. When you try and identify based on samples, you try and conclude on the population. Okay, so what do you evaluate? You evaluate the identified misstatements on audit and the effect of uncorrected misstatements, if any, on the financial statements. Not all misstatements are typically corrected by the management, at least so in the larger organization. They would also typically come back. The management will also, they are smart. They will also know your materiality because you would have presented to them through the audit planning process, to the audit committee and those charged with governance, to the board as well. So they would be aware of your materiality and they would also typically tell you it is well within your materiality. Why do you need a correction? Why should I adjust it? Right? There are managements which will go ahead and correct and adjust, and there will be managements which will not. And they will correct some and they will not correct the others. So then you need to understand why these are corrected, why these are not corrected, and what is your conclusion on that front. Okay. Now, what is a misstatement? Simple. Any difference between the amount, the classification, the presentation, or disclosure in the financial statements as against what is required to be as per the financial reporting framework. Okay, which includes obviously the law and regulation also. So if certain thing is required to be in a certain manner, certain amount, certain presentation, right, certain disclosure, classification, and if it is not according to that, then it's a misstatement, right? It also includes adjustment which are necessary in auditor's judgment to provide true and fair. Now, the financial reporting framework may not have specified, may not have gotten around to specify out there, but you as an auditor believe that this is required to present a true and fair view. Let me give you an example for that, where the financial reporting framework has not necessarily talked about crypto assets, and some entity has probably has investment in crypto assets. Okay, and it gives you a fair value quotation as reflected out there. But there's a FEMA requirement or there's foreign exchange whereby you cannot transact, let's say, right? Or there are other requirements whereby you cannot transact. So there may be a fair value to it, but then there are limitations. So you would need the company to mention that this is not available, right, in such a form and manner. You cannot, though you may have a fair value quoted in the outside exchanges, or you may have fair value, but the exchanges themselves have become bankrupt, which is what we saw, right? World and many others which have gone bankrupt. So in such a case, that in your judgment, though there is no financial reporting framework which talks about it specifically, so the management may come to you and say there's nothing which is given, so we'll do the bare minimum, which will just record that, which you may come to the conclusion that is not good enough. You'll need to disclose other items, the restriction, right? The encumbrance, if any, or inability to sell, whatever. So that may come up in that sense. It may arise from fraud or error, misstatement. Again, if it's a fraud, we need to be all the more careful. We need to be suspicious. We need to sniff out if there are any frauds. We need to do a brainstorming. There's SA 240 for that. So SA 240 covers specifically what we need to do if there's a suspicion of fraud, right? Even we have to go beyond a suspicion of fraud to actually find out fraud risk factors, right? Again, so it's a combination of all those standards. Uncorrected misstatements. Misstatements which are accumulated by the auditor and they have not been corrected. Yeah. Basic flow of the audit process, which you are aware of. I will not try and go through that. Accumulation of identified misstatements. I'll try and give you what are the types of misstatements. Okay. But prior to that, let me talk about it. So, like I mentioned, right? Yeah, there's a materiality. So Reliance example, 30,000 crores PBT, I did 5%, so which is 1,500 crores materiality. I probably set up a performance material at the financial statement level at 1,000 crores, right? It could be 65%, it could be lower, depending on the audit judgment, right? Professional judgment as the case may be. For the sake of this example, let me take it at 1,000 crores as performance materiality. Now again, obviously the size of Reliance, you don't expect no errors to be there ever. Size may be a smaller one, maybe a bigger one, that there are errors which are likely to be there. Okay, so there are errors which are clearly trivial. Typically, it is set up at no more than 5% of the materiality as such. But in general, practical usage, I have seen 2 to 3%. Even in a Big Four setup, when I was there earlier in my earlier career, we used to take it at 2%, which was a flat 2%. But maximum you allowed is 5%, right? 5% is what is generally understood to be clearly trivial, or lower than that, I would say. So you can take it up at 2%, 3% as the case may be. So if it's clearly trivial, you don't even accumulate it, right? Clearly trivial, you don't even accumulate it. Typically, I am a little conservative on this front. I know clearly trivial does not need to be accumulated, but typically I first and foremost try and get all the errors in to be reviewed at a certain level and then come out that this error, though may be clearly trivial individually, but does not give me an idea of any pattern, right? Or some bias as such. That is my conservatism. But typically, you are allowed anything which is less than 5% of the materiality is clearly trivial. You don't even need to accumulate it, right? So that is where the standard allows that flexibility in that sense. Again, clearly trivial is not the same thing as not material. Let me clarify and specify that. Let me reiterate once again. Clearly trivial does not mean it is not material. Clearly trivial is only meaning to say it is insignificant in the overall scheme of things and you may not accumulate. Okay. And there's again a difference between material, immaterial, and not material. Again, not material is immaterial. No, there's a difference between the two. Okay. Now, types of misstatements. So, what sort of misstatements do you come across? The factual, where there's no doubt about it. An amount needed to be recorded 10,000, it has been recorded 8,000. So, there's obviously a difference of 2,000, which everyone agrees there's no doubt about it, which is factual. Then there's judgmental. Judgmental is, differences between the management and the auditor in terms of how and what amount the estimate should be, what accounting policy to be selected or applied, right? Those are judgmental. The management may have a valid view, okay, valid judgment that they may have applied, but you may not be in agreement. Let me give you an example. Provision for obsolete inventory, provision for doubtful debts, right? The management is recorded at, let's say, a crore rupee. And I, as an auditor, believe that should be in the range of 150 lakhs or 1.5 crores. Okay. And that is my lowest range. I'm not giving a point estimate. That is my lowest range from 1.5 to 2 crores. And the management is recorded 1 crore. Okay. And neither they are able to see my view nor am I able to see their view. And there's a judgmental misstatement. So we say 50 lakhs is the misstatement out here between what they have recorded and what my lowest point is in the range. Okay. This is an example which I'm giving. This sort of examples you'll find in the implementation guide going forward also. Then there's a projected misstatement. Obviously, when you take samples to conclude on the population, whatever errors that you find in the sample will have to be projected towards on the entire population. You can't say, let's say if I'm testing revenue, and in the revenue, there is, let's say, again, taking an example of Reliance, 5 lakh crores of revenue. In 5 lakh crores of revenue, my sample size is probably, let's say, 1 lakh crore. Okay, 20%. In that 20%, I came across an error of, let's say, 1 lakh crore. I came up an error of 5,000 crores. I'm taking numbers purely from my mind, right? No relevance, no reference to actual numbers at all. Okay, so it's 5,000 crores. So can I say I accept 5 lakh crores of revenue, only 5,000 error, and I cannot say that. I need to project it over the remaining 4 lakhs so that I come across the error on the entire population as such. Okay, now projected misstatements in terms of extrapolation may not be as difficult. You know how to extrapolate it. If 5,000 in 1 lakh, then how much on 5 lakh? That's a simple arithmetic calculation that you can do. But projected misstatement, which management would be ready to adjust for it? No one, typically, right? It's a projected misstatement. It may be there, it may not be there as such. But there's a limitation. In the audit process, you typically cannot look at the entire population and you're looking at samples, and that is why you have to do this. If there's a way that you can work out where you can look at the entire population, you get a higher satisfaction and looking, right? You can now, because of this data analytics and the entire, you can probably look at more data than what you were able to look at earlier, right? You can get probably better evidence, okay, higher level of evidence as compared to what you were able to do earlier. So that is something that you may need to consider. Technology plays a role in that sense. But again, like I said, projected misstatement is something that the management may not agree to adjust. If you are in the shoes of the management, you wouldn't, I wouldn't probably. Now, consideration of identified misstatement as the audit progresses. Again, you come across misstatements in different areas at different points in time. Let's say you've done an interim audit and you looked at the flow statements, which is to say P&L primarily, and not the balance sheet items. You plan to look at the balance sheet items, let's say early February. Okay, just before March, you want to look at it, and the flow statements you have taken it up and looked at it up to, let's say, November or December, as a case may be, 9-month period. Let's put it across as such. You come across errors in there. Okay, so those errors, you don't need to wait for the entire audit completion. You can, based on those errors, you can start considering whether it is likely to impact your materiality going forward, right? And you need to identify, assess nature, size, circumstance of occurrence. You need to communicate with the management, right? The right level of management. The right level of management is one which can actually take action and correct it, or either case tell you clearly that this is not an error, and they can give you reasons for it in that sense. Okay, so your overall audit strategy and audit plan may need to undergo a revision depending on the level of errors that you come across, right? Because your materiality is based on expectation level of the misstatement that you might come across. Okay, so if that itself undergoes a revision or likely to, then you will have to rethink the further audit procedures, the audit procedure that you conducted so far, and the entire communication and correction of misstatements. Like I mentioned, communicate on a timely basis all misstatements to accumulate during the audit to appropriate level of management. You need to communicate. The appropriate level of management is the management which is in a position to take action on that. Okay, you request the management to correct misstatements. Typically, that is what every auditor would do, right? Don't say that I have come across errors of, let's say, 800 crores in my audit of Reliance, whereas my materiality is 1,500 crores. So I'll not ask them to correct. You request the management to correct the misstatements. If they are not ready to, then you need an explanation from them why. Understand the reason for it, right? Just because they are not ready to correct the error, that does not by itself mean that the financial statements do not show true and fair view. Because in 30,000 crores, you got 800 crores of errors, your materiality was 1,500 crores, you're okay signing off on true and fair. But nevertheless, you still ask them to correct, and you get the reason from them why they don't want to. They don't want to, right? So now, this all identified misstatements, and now uncorrected misstatements. Uncorrected misstatements, materially, right? Are they individually or in aggregate material or not? The factors that you would want to consider: size and nature, circumstances of its occurrence, and the effect of uncorrectness related to prior periods. Excuse me. This is something which everyone has been missing on primarily to great extent. At least those people, those professionals I discussed with and whom I work with, the effect of uncorrected misstatements related to prior periods. Typically, people think that once they qualified the audit report of the prior period, your job is done as far as that is concerned. If that has not been corrected, even in the current period, your job is to communicate the effect of those errors and even factor that in when forming an opinion. That you can refer to the SA 700 series, which I'm sure you looked at it and you're comfortable with it. But typically, it is not properly captured in the template. There are uncorrected errors. Let's say you mentioned in the previous year, so and so was done. Okay. I can give an example. Let's say this Banpur cement and everything NFRA has observed through these orders, whether it is Banpur Cements or some other entity. I think it is Banpur Cements, where the previous auditor had qualified their report. The incoming auditor, the new auditor, subsequently dropped the qualifications. Okay, and when inquired, when show cause was given to the incoming auditor as to why did he drop those qualifications, why did he not refer to them, the response was because it was already qualified in the previous period. I had nothing to do on that front in the current period. Where the NFRS pulled them up that this is not right in terms of the thinking as per the standard. This is not the right application of the standard also. So again, the same effect comes in 450 also. So not only in drafting and forming an opinion on the financial statements, but in the evaluation of misstatements also you need to consider uncorrected misstatements related to prior periods. Consider each misstatement to evaluate its effect, right? A material misstatement is unlikely to be offset by other misstatements. Sometimes you come across errors. Let's say while you're testing revenue, you come across an error: 1,000 crores overstated, 800 crores understated. Okay, so 1,000 and 800 in the same account balance, same class of transactions, there may be a question of offset. You may be able to offset, but 1,000 crores overstatement in revenue and 1,000 crores overstatement in expense, overall profit would be knocked off by that extent, but you cannot have an offset because that is revenue, that is expense again, right? So as far as the PL may be offset by it, 1,000 crores both places, but you cannot have an offset on that front because those are different elements altogether, different class of transaction, different account balances, and different disclosures. Okay. So you may offset immaterial misstatement within the same account balance and class of transactions. Okay. But that also, again, you'll have to look at it. Like I mentioned, if 1,000 crores overstatement revenue and 800 crores understatement revenue, you can't just offset it just like that. You need to look at it. You need to identify how that has happened, right? If there's a possibility that 1,000 crores could be projected onto it, or you can't net project it only. That's what I'm trying to say. Classification misstatement is material. Okay. Classification could be from asset, liability, from within assets, also current to non-current, right? Within financial to non-financial asset. So many classification that you require to make. So classification misstatement, it could be there. Okay. So evaluate whether misstatement is material is also affected by law and regulation. Any additional responsibilities on the auditor to report on other matters, right? For example, fraud. Again, Companies Act very well lays down what is the auditor's responsibility as far as fraud is concerned. There's also 240 which lays down the other standards also which lays down, right? So you need to factor that in. Public interest accountability, probity, where people are focusing on particular matters, then again that comes up. Cumulative effect of immaterial uncorrected misstatements. That is what I was stating earlier also. See, immaterial uncorrected misstatements, you need to look at the cumulative effect also of the prior period as well as the current period. So that is why in the first instance, though it's clearly trivial, there's a concept called clearly trivial and you do not need to accumulate it. I would still record and accumulate in one place, then later on take a call and remove it, as the case may be. In the first instance, I want that information. I want to look at that information. I want to review the information. I want to get to the root cause of that, right? Not each and every one. Some are very pretty simple and clear that I don't want to go and get into the root cause, but some I may want to. At least I want that information. Okay, so that I can at least analyze the information, if not the evidence supporting behind it. Communication with those charged with governance. Again, you communicate all uncorrected misstatements. I would typically even communicate the identified misstatements which have been corrected, as a part of greater communication responsibilities or greater transparency. I would be more than happy to even communicate those misstatements which have been corrected. I would like to split it up and show them this have been corrected, these are uncorrected. Okay, and you need to take a view of the board or the audit committee, whether you need to make a request in the first instance for them to be corrected, and if they are not, then the view has to come from there, right? That why this will not be corrected or why this hasn't been corrected, and their view that this is not material to the financial statements. You need to get it from there. Typically, MRLs I've seen that they have this statement on it. Statement is like a standard MRL that we have, and we have statement, but we don't have a listing of the errors. So typically, NFR has also taken a call that what misstatements have you ever identified? If your papers do not show that, if your documents do not show that, nor have you ever communicated to the board ever, right? Or the audit committee, or those charged with governance. What is the case for you to tell me later that you identified errors and you've gotten it corrected, but it does not come out anywhere? Neither in the documentation, neither in the uncorrected also, where you say that you communicated to the board. Okay. So that is something which you need to understand and question in that sense. Okay. So unless prohibited by law and regulation, there may be instances where you may come across certain frauds and which may not be communicated, which may warrant some confidentiality or secrecy in the first few days or months, as the case may be, or the first period of it. Thereafter, you'll obviously have to communicate. But if a law and regulation requires you not to communicate, then you should not. And if you have doubts, obviously, legal opinion is the best thing that you need to obtain. Written representations, obviously, but be mindful that a summary of such items to be included. Give the entire listing of uncorrected misstatements. If there are many misstatements, then you need to give only numbers in the amount in aggregate. Then you may not give individually, right? You may give it by category wise. You can categorize it as such, if at all. You may not want to say 50 errors like that. If it is 25 relating to revenue, then just give it accordingly, depending. Documentation, again, an important part. This going forward, I'm sure this will be a focus area for NFRA, that what is it that you documented? What are the errors that you actually conveyed to the those charged with governance? Okay, give me a list of it. Show that to me. Whatever you gotten corrected, what were your observations? Because they have already seen, and it is clear. Currently, what they looked at is the broader issues which were there in those financial statements, typically like going concern issues and all such things. So they're not even required to go down to the level that show me the errors that you have communicated, show me the errors that you identified, right? Even the major significant things were not caught up or picked up, and that is being taken up by NFRA currently. But going forward, this standard also would be of prominence to them in terms of reporting, in terms of their assessment. Again, this is the implementation guide, as I mentioned. So this was the presentation format, the PPT format, so to speak, of those two standards. The standards are available on the public website. This is also available on the ICAI website as such. Then they have given you examples below out here. They have given you examples. First, they have given you references of materiality in the financial reporting framework. The concept of materiality in the financial reporting framework. Forget the auditing framework, auditing standards, but the financial reporting framework. So where all materiality here as a concept has been brought in. Paragraph 32, preface to accounting standard guidance note and terms, AS1, guidance on an accrual basis, IS1, 31, 34, right? These are the places where materiality has been referred to in the financial reporting framework. You may just want to refer to it quickly. It will not add great value to that extent, but this is where accrual, what do you mean, concept of true and fair view. These are important things, factors for determining materiality. How do you go about doing it? What are the benchmarks to be picked up? After you picked up or chosen a benchmark, what are the percentages that you apply to the benchmark? So there are examples which are given out here. Okay, so we look at these items. Typical benchmarks. Again, like I mentioned, these are typical. These are based on what people have been doing, right? General understanding. This is not cast in stone that this is what you need to pick up in this case, okay? Because it's all based on the specific understanding of the entity as such. So profit loss before taxation, turnover, revenue, net tangible assets, current liabilities. It could be income or expenditure of an exceptional non-recurring nature, trend in turnover. All these factors need to be taken into consideration while looking at the benchmarks to be chosen. Okay, what is performance materiality? We looked at it at the top. Examples of application of performance materiality. Again, there's no benchmark in terms of, okay, there are benchmarks rather. There are no cast in stone sort of factors given to you. There are factors which have been given that you may need to consider. There will be n number of factors depending on the entity, like variation between 5 to 10% of current year from previous year, cost of repairs to fixed assets, closing stock to this one. They give examples of it. I would highly advise and require you to look at this document if you really want to work out a concept of materiality. This document and one other which I'll show to you, which is the ICAW document also. The what is England and Wales implementation guide. They have a guide on materiality, which is also good document. If you refer to the document brought out by ICI, the one that we are referring to right now, and the one which has been brought out by England and Wales, this will provide you to very comprehensive understanding of materiality and determining the materiality, along with the template which has been provided by the ICI, right? Which you can obviously modify and alter as you think fit. What is a misstatement? What is uncorrected misstatement? Determine the threshold for clearly trivial misstatements. Okay. Illustrative factors. Again, this entire document will only give you illustrative factors. Like I mentioned, there's no cast in stone. Again, because there's no one size fits all. Depending on the understanding of the situation, circumstances, the entity, nature of the entity, history of the entity, right? All of those factors would have to be reckoned with in order to work out your factors. So the benchmark also, then the factors to be applied to the benchmark, apart from the size and everything. So let me take you to the examples itself. I'll take certain examples for you because this examples you can go through it. It is better to do it individually, right? More than the group. Group, if it was a workshop sort of a discussion, then I would have been more than happy to take you through each and every example and more. Right? I can give you more examples beyond this also. There are obviously documents available. I can give you from my own experience also as such. But let me take up these examples. I'll take it probably two examples to just set the tone in that sense. Materiality for entity AA has been set at 5 million for the current period audit, and the engagement team is about to determine performance materiality next. Entity AA is an IT consulting firm, and there have been no significant changes in the entity's business, internal control, risk of material misstatement, or management. The entity has been an audit client for the last 5 years, and the uncorrected misstatements have been in the region of 20 to 30% of materiality during the client relationship. So 20 to 30% is the range of misstatement that you have detected or come across during the last 5 years of your relationship with the client. Last audit's uncorrected misstatements amounted to 1 million. 1.034 million, right? None of which carry over to this period. So as you can see from the first example itself, none of which carry over to this period. So that's an important consideration. The engagement team determined performance materiality with 3.5 million. So this is given you an answer. Your materiality was 5 million. It's an IT consulting firm. No major significant changes have occurred in the entity's business, internal control, or material misstatement, okay, or the management for that matter. And you have had a 5-year relationship with the client. You know that the misstatements are typically in the range of 20 to 30% of materiality, right? You know what was the last year's uncorrected misstatements, and based on that, you worked out materiality, performance materiality at 3.5 million, right? So you've taken 30% lower because 30% was the highest point of uncorrected misstatement that you came across. So you probably use that as a basis. Now again, someone can pick up at 2.5 million also. Someone can say 3 million also out here, right? Again, it's a matter of reasoned judgment. Okay. You will not be able to say right or wrong in that sense completely because you'll have a range to work with as such as an auditor. The more conservative you are, the better it may be in terms of, yes, you may end up doing a little higher work, but at least as far as the effectiveness is concerned, the probability of you being effective will also increase, right? So that is the way I look at it because I am a little conservative on that front. Let me pick up the example two. For the following audit of entity AA, materiality has been set to 5 million again. The uncorrected misstatements in the previous audit were 1.24 million. There have been no significant changes in the entity's business, internal control, or risk of material misstatement, but the entity has partly new management starting a few months into the current period. So, like we saw in example one, there were no significant changes in the entity's business, internal control, or risk of material misstatement, and even the management. In the example two, we have a change in the management. partly new management starting a few months into the current period. So that may possibly give rise to control risk or a inherent risk in that sense, inherent assurance, so to speak. In planning meetings with management, they declare that they intend to correct all identified misstatements unless clearly trivial. So, if in the planning meetings, a management discusses and agrees with you, and they declare that they will correct all identified misstatements, nothing like it. Best thing, if all identified, even with if it's within materiality, they are ready to correct it. It's the best thing that you could have, right? So, considering the above circumstances, the engagement team determined performance materiality to be 4.5 million. Now, you can contrast this example with the first one. The first one, if you refer to, there was 5 million, 20 to 30% of uncorrected errors in the last 5-year period. So let's say 30%, then you came to 1.5 million. Last year was only 1.03 million, and you determined 3.5 million as performance materiality. Here you had 1.2 in the previous period. But nevertheless, you came up with 4.5. Why? Because in the planning meeting, the management said they'll correct all the errors. Okay, so that influenced your decision and you came up with a higher performance materiality. Again, like I mentioned, this will be based on judgment. I would still be conservative. Probably that's the way I am built, or it's hardwired into me. So I would take it at a lower level. I don't want to come out at a later stage, right, where I have done insufficient work and I need to do some other work. So I will always take it at a lower level, right? But in this example itself, they given an idea. Though the previous year misstatements were higher in the example 2 as compared to example 1, there were no changes in the management also in the previous example. And in this, there is a change, partly new management. Nevertheless, what has played an important role is their declaration of correcting all identified misstatements. And that is why you came up to 4.5 million. I may have still gone with 3 million or 3.5 million. I'm sure there will be views available, right? We can discuss that subsequently. Let me take an example here. So here they given an example. Materiality could also be based on reference to, the earlier revised Schedule 6 of the Companies Act. They say for disclosure purposes, 1% and higher of the revenue needs to be disclosed as a separate line item as far as expenses is concerned. So that also could be factored in for disclosure purpose. Obviously not for other purpose, but for disclosure. Right? So that is how the financial reporting framework plays a role in the materiality understanding at a lower level, not at the financial statement level, but at the assertion level, at the account balance level, at the transaction of the disclosure level. Now, so this document provides a lot of examples. So I would bear with you in that sense. Please look at this, because obviously I cannot look at each and every example within the time frame given. It will take time for that matter. I'm more than happy to refer to it later, subsequently, when anyone wants to discuss it. Right, my contact details will be made available to you. All the documents that I referred to are publicly available from the ICA website. I'll also give references to it in the PPT that I share with the ASP secretary, and they can refer to it. In addition to this document, please refer to the MCQs. These are multiple choice questions along with the answers. This is something which the ICA has put out for each and every sender. So you can test yourself as a professional, you can give it to your students also. Right? This is something which has already been done by ICA and put up already. I'm sure many of you would be referring to, but for those people who have not come across this, I would highly advise you to look at this document and look at this first, right? I would just wanted to start off with the MCQs first, because if you look at the MCQs and if you respond to it, and if you get many answers right, then you just need to focus on those areas and where you are not getting it right? And you need to go back to drawing board and look at those areas. Obviously, if you read the entire standard, is always good, but you can refer to the implementation guide in that case. You may refer to the PPT right? And you may look at the examples out there. MCQs is something which you can take away in that sense. I'll give a reference of that. That is available. That is put up by the ICI. Let me take you to the first page itself. Multiple choice questions. This has been put up as of 1st July 2020, right, by the ICI itself. ICI has put up a good amount of material available out there, MCQs, implementation guide. Okay. Then this is a diagrammatic representation of our audit process as such, and where we are discussing the identifying the risk of material misstatement out here, right? At the financial assertion level. This was just in terms of diagrammatic flow, and that this is also available in the other implementation guides of ICI. Okay. Now let me take you to what I see will happen going forward in the reporting context as far the audit reports are concerned. I'm just trying to bring up a few audit reports, which I think you would have obviously referred to it. This is something which is there in the UK and Europe, where they started expanded audit reports. So expanded audit reports was in addition to the opinion, para, basis of opinion, those are same thing that we also have. Key audit matters which we introduced, right? But in addition to key audit matters, there was the materiality, where you disclose the materiality to the shareholders and stakeholders, right? Planning materiality, performance materiality, and the reporting differences. This is something which was, excuse me. So this was something which was brought about as part of the expanded audit reporting requirement. This has been in existence for last 4 or 5 years. UK, and they are also thinking of implementing it elsewhere. Australia and many other countries have also started. And I would tend to think that sooner rather than later, this would come in the Indian context also. Probably 3 or 4 years down the line, if not earlier. Right? So, which makes it all the more transparent. What was the materiality which you used? Now, this sort of reporting was always required to be done with those charged with governance, which is to say the board and the audit committee as such. Right? You're supposed to give your materiality, performance materiality, the errors that you identified, corrected errors, uncorrected errors, the reporting differences, all those was required to be communicated to the board and the audit committee. Now this will be transparent in the audit reports itself to all the stakeholders. As you can imagine, the more you give out, the more you stand exposed to being questioned, which is good, right? Which could be a deterrent also, but typically the more the sun shines, the better it is. That's the way I look at it. So even our revised Schedule 3, okay, with many of the changes, it is just trying to make it more transparent by disclosing and reporting many of the things, which even otherwise as auditors you would look at and the management would have been doing, but they disclose more information in terms of aging and many other things out there, right? So here in the audit report also, which I expect which will come up. This is Shell. Anyone who wants to look at it, you can look at, typically UK companies. The Shell is one of them. The other one which I picked up is Rolls-Royce. Okay. Rolls-Royce out here. So if you pick up our audit approach, it may be colorful, it may not be colorful, it may be in text form. That's a different thing. But what comes out is the materiality thresholds. This materiality. What was the materiality which was determined? What was the benchmark applied? What was the factor applied to the benchmark? Right? What was the group materiality, performance materiality? Everything is given out. It'll also give what is the error or the reporting differences. So every auditor may do it differently. You can go beyond what the standards require you to do so, but at least the standards. And this materiality disclosure is a part of the expanded audit reporting requirement in the UK for the last 4 years at least, if not more. My memory serves me, it is at least 4 years. And other countries are also falling in place. So I am sure sooner or later it will come down here also. Then the third report which I had was National Express. Okay, this is the way they mentioned it out here. So there is a reporting on it. You may be too, the format is left to you in that sense. Okay, so given what I think will come out sooner or later, but it's better that we start off and we also make this presentations to the board, to the audit committee, communicate to them directly, right? What was the materiality? Are we planned out? It is required even otherwise by SA 260 and 265, right? The communication of to those charged with governance. That is also what has been reviewed by NFRA in different entities. Whether did you communicate to those? Excuse me. Whether it was communicated to the board or the audit committee or not. So that also they picked up in some of the cases, not all the cases, but going forward, I'm sure they'll pick that up clearly. Show me your communication to the board. Show me your communication to auditors. They'll also pick up from the company side. Show me the communication by the auditors to you, right? So both way they're likely to do that, and they'll be very clear on that front, right? So then you have to clearly state what are the errors that you came across. Then they'll also ask you for your MRL, and if you don't have a summarized statement which has been signed off on, they'll also tell you what have you communicated. You're not communicated to them. Work not document is not done, as I said. So that is what is likely to come out of it. So this is it primarily. Right? I think I saved a lot of time because I could not take up the MCQs in the manner which I intended to. I was under the impression probably I will be able to get live feedback on the MCQs and we can make it more lively and focus and concentrate on those areas where we probably have a lesser understanding or we get it more wrong than right, and we can look at those areas. But nevertheless, these documents I'll definitely leave references linked with the ASB secretariat, and you can refer to it from there. Beyond that, I have nothing more to say on this one. If there are specific questions, I'm more than happy to take that up. Gauravji, Anilji.
Yes, sir. Gaurav ji.
हाँ जी सर, हाँ जी
Gaurav ji, are there?
हाँ जी, एक क्वेश्चन क्वेरी भी थी ना
जी सर.
जी, एक सेकंड सर. एक क्वेरी है, विद एआई एंड कैट टूल्स being used in financial FS audit, wherein audit team is able to test entire population, that is 100%, how to adjust planning and performance materiality.
Okay, it's a good question. It is very topical and relevant in terms of what is happening. Now, like I mentioned briefly when I was stating that with data analytics, right, the sampling what was used to be done earlier, right, as against looking at the entire population, because there was a limitation in terms of your ability to look at the entire population. If you are able to look at the entire population, your conclusion of the population would be far better off. Materiality would still remain. Just because you looked at the entire population does not mean that there's no errors in the population, right? Population may still contain errors, may still contain misstatements, as the case may be, just like a sample does. You are using a sample to conclude on the population, so you are having limitations of inability to look at the entire population, which I suspect you will still have going forward in some of the areas. Many areas you can do a better job, far better job, given the tools available to us today, the technology available to us today. We are in a far better position to look at entire population, right? As compared, why do a sampling if you can look at the population? It makes no sense. If you can devise other ways of looking at the population, if you can do a data analytics, right? If you can analyze data better, if you can pinpoint what you want to look at, focus manner. Why use a machine gun when you can use a sniper gun to shoot someone? मशीन गन में बुलेट्स इतना क्यों स्पेंड करने का, बराबर इतने एम्यूनिशन क्यों बिगाड़ने का, खर्चा क्यों करने का, जब स्नाइपर गन से अगर आप 1 माइल के दूर से कर सकते हो, आपके पास इतनी एबिलिटी है, तो वही कीजिए. Okay, so that is beyond question. So the participant has a very good question, and AI and data analytic tools, it will not impact materiality determination. It will not impact the errors that you find in the population, but it definitely impacts the type of work that you do. Yes, the factors for determining materiality may undergo change. You might come across a situation where the level of uncorrected errors or your detection risk is lower. right? So
Right,
your
right.
sampling may undergo change, if at all, if you still want to sample. If in certain areas you can't sample, so
Okay.
can't look at the entire population. I hope I have answered your question.
Hanji, Hanji. Sir, due to some technical issue, we don't have any other question. But one more question I have. If we take 10% of revenue as OM
Hmm.
and 8% as PM
Hmm.
and 4% as sum,
Hmm.
is this the correct logic for an audit planning to start with?
Of revenue, you cannot typically, because that is too high a base. Let me give an example of Reliance, which I was using. Reliance has a 5 lakh crore turnover. If you take 10% of that, 50,000 crores, then you don't need to do anything else. हो गया खत्म आपका. समझे? Materiality इतना है high. 10% on profit before tax is still acceptable. They give examples also. But typical thumb rule across the global scenario is 5% of profit before tax. But this is typical. It's not an exact cast in stone. There's no one size fits all. But 5 to 10% of profit, and on revenue, it is 1 to 2%, 2% maximum, but generally 1% and less.
Okay.
That's how they're going about it. So 10% revenue, 8% performance materiality, again based on revenue, and 4% on this one will not be acceptable on revenue. But if you are talking about it in terms of profit before tax, it can still pass the muster.
Okay. Sir, all other question we will mail you for reverting.
Fine. Okay.
Okay. Thank you so much, sir, for sharing your valuable knowledge with us and for on this wonderful topic organized by the Auditing Standard Board on webinar on the 320 essay. Thank you very much, sir, for sharing your valuable knowledge. And over to you, Anil, sir, for concluding remarks.
Thank you so much, sir. Thank you so much, Chairman, sir. Thank you so much, today's speaker. Sir, thank you so much on behalf of Auditing and Assurance Standard Board of ICI. We have gained a lot through your deliberations, sir. For more than 90 minutes, you have spoken at a stretch without the two-way communication. So hats off to you, sir. We have gained a lot regarding both these standards and hope our participants have also gained a lot through your deliberation. So on behalf of Auditing and Assurance Standard Board of ICI, I extend my heartiest thanks towards you, sir, for sparing your valuable time. Apart from your busy schedule as well as the other contingency in the family as well as in the your side, but you have acceded to our request to deliberate today. Thank you so much, sir. As well as I also thanks to the Honorable Chairman of Rohtak Branch, Gaurav Bansalji, for sparing your valuable time as well as moderating this webinar. Thank you so much. Thank you all the participants for today's webinar. Thank you so much, sir. Namaste.
Thank you.
Thank you, sir. Thank you.
Thank you, sir.